$4 trillion recovered in just 30 hours. Gold up 11%, silver up 20%, while retail investors were panic selling at the bottom. But here's what they're not telling you. China just published an official document, Xi Jinping's own words, revealing their endgame for global currency dominance. And while you were watching paper prices collapse, Singapore had queues forming outside banks. Vaults drained 2.8% in a single day. The largest silver ETF in the world hit trading volume higher than any stock on earth. Someone moved $4 trillion in 30 hours. And it wasn't retail. The question isn't whether the squeeze is coming. The question is, do you understand what just happened while everyone was looking the other way? Welcome to John Talk Show. If you've been in markets long enough to remember when gold was $300 an ounce, when central banks actually backed their promises, then you know the value of straight talk without the noise. We'd appreciate if you'd subscribe to this channel, not for algorithms, but because solid analysis shouldn't be hard to find when you need it most. And tell us, where are you watching from today? New York? London? Singapore? Drop your city in the comments. Because what's happening in precious metals right now affects every currency, every market, and every retirement account on this planet. Now, let's talk about what really happened in those 30 hours. In the span of just 30 hours, global precious metals markets added $4 trillion in market capitalization. Gold climbed 11% from its bottom, reclaiming the 4,180 level and adding $3.07 trillion to its total valuation. Silver surged nearly 20%, pushing back above $88 and restoring $800 billion that had been wiped out just days earlier. Together, these metals recovered roughly 35% of the recent $11 trillion destruction that had rattled investors worldwide. But here's where the story becomes interesting. This massive recovery happened while retail investors were capitulating in panic. The reversal occurred precisely when individual investors were selling at the worst possible moment, convinced the bottom was falling out beneath them. This wasn't a natural market recovery driven by renewed retail confidence. This was something else entirely. What markets witnessed was a textbook example of forced liquidation on the way down, followed by an equally violent short squeeze on the way up. The volatility itself wasn't the problem. For those who understood the mechanics at play, the volatility represented the opportunity. Gold pushed back over $4,900. Silver reclaimed $88, both bouncing sharply from what appeared to be catastrophic declines from all-time highs. The question that professional analysts are now asking is simple: who moved $4 trillion in 30 hours? Retail investors don't possess that kind of capital. Individual traders don't coordinate movements of this magnitude. The answer lies in examining the actual trading data from those 30 hours. SLV, the largest silver-backed exchange-traded fund in the world, recorded trading volume of $41 billion on Friday alone, to put that number in perspective. SLV's activity exceeded the trading volume of any single stock in the entire global marketplace that day. That's not retail activity, that's institutional capital moving at scale. That's algorithmic trading systems executing massive buy orders at predetermined price levels. That's sovereign wealth funds and central banks quietly accumulating while headlines screamed about precious metals collapse. Meanwhile, physical markets told a completely different story from paper derivative pricing. In Singapore, retail investors formed queues outside United Overseas Bank, the nation's only bank offering physical gold purchases. Even as screen prices plummeted, buyers packed the lobby, purchasing physical metal with both hands. These weren't panicked sellers. These were informed buyers, recognizing the disconnect between paper price and physical value. The scene highlighted something critical. Sharp declines in paper markets weren't deterring physical buyers from adding to their positions. If anything, the crash accelerated physical accumulation. Bullion, a major dealer in the region, reported being down to their final 1,000-ounce silver bar available in pre-sale. After that single bar sold, this major bullion dealer would be completely sold out of the exact inventory format that industrial buyers require. The physical shortage wasn't theoretical. It was measurable, verifiable, and accelerating. But perhaps the most telling indicator came from vault data. In a single 24-hour period, registered silver vaults drained by 2.8%. Not over a week, not over a month. 2.8% gone in one day. At that rate of depletion, the mathematics become uncomfortable for anyone holding short positions in physical delivery contracts. Now consider what this means when examining COMEX silver futures open interest. Friday's price smash managed to reduce total open interest by only 5,600 to 6,000 contracts, bringing the total down to approximately 142,000 contracts. For context, back in 2011 during the Reddit-driven silver squeeze attempt, this figure stood north of 250,000 contracts. Current open interest sits nearly 40% below those 2011 levels. Yet volatility patterns and price action suggest something far more significant is building beneath the surface. The data contradicts the narrative that retail speculation is driving current moves. Retail was selling at $73 silver. Institutions were buying. Retail was panicking at $4,400 gold. Central banks were accumulating. The $4 trillion recovered in 30 hours proves a simple truth that many investors missed while watching their screens. There's a fundamental difference between the paper derivative price, the number that flashes on trading terminals, and the actual cost of securing physical metal for delivery. The screen price represents leverage, speculation, futures contracts that may never result in physical settlement. The real price is what it costs to obtain metal in your possession, and that spread between paper and physical has been widening, not narrowing, throughout this volatility. Singapore queues forming during a crash, vault inventories draining at accelerating rates, major dealers selling out of industrial bars, SLV volume exceeding every stock on earth, $4 trillion recovered while retail sold. These data points don't align with a market in collapse. They align with a market where informed capital is positioning for what comes next. The question isn't whether metals will recover. The question is, who understood what was really happening during those 30 hours? While Western analysts were focused on hourly price charts and technical indicators, something far more significant was published halfway around the world. On the official website of China's central government, an article appeared that most English-speaking investors never read. The author was Xi Jinping himself, the title, Building a Financial Power. At first glance, it seemed like standard political rhetoric, the kind of policy document that gets filed away and forgotten by Western media. But those who read the Chinese version discovered something extraordinary. The Chinese text was substantially different from the English translation, not just in tone, but in explicit strategic detail. The document outlined 6 core tasks for establishing China as a global financial power, and at the very top of that list, priority number 1, was a single objective that should have made every currency trader in the world stop and take notice. Having a powerful currency, not infrastructure development, not technology leadership, not even military capability. Currency power ranked as the highest priority task. But the document didn't stop there. It specified exactly what the prerequisite for currency power requires. According to Xi's published strategy, China must gain pricing power of gold. Let that phrase sit for a moment. Pricing power of gold. Not simply owning gold, not accumulating reserves, but controlling the mechanism by which gold is priced globally. The document laid out 3 operational requirements to achieve this pricing power. China must become the #1 producer of gold in the world. China must become the #1 consumer of gold globally. China must become the #1 importer of gold internationally. And finally, China must possess the world's largest gold reserves. These weren't aspirational goals. According to the article, China is already executing this strategy. The document was published in Chuxi, the official theoretical journal of the Communist Party of China, and it contained a phrase that sent ripples through those who understood its significance. The article described this initiative as the September 3rd military parade in the financial sector. For context, September 3rd in China commemorates victory in World War II. It's a date associated with decisive national triumph. Calling this financial strategy a military parade wasn't accidental language. It was a declaration. The article stated plainly that China is close to completing its preparation phase, that its massive gold reserves will support the internationalization of the renminbi, and that the global gold final battle is about to break out. Not might break out, not could eventually occur, about to break out. The document explained that gold defines the value of all national currencies in the emerging international financial and monetary order, and that China positions itself as one of the main players in this final battle. This wasn't speculation from an independent analyst. This wasn't a think tank white paper. This was official Chinese government policy, published under Xi Jinping's name on the central government's website. Now the data begins to make sense. In November, China purchased 10 tons of physical gold. The official report to international agencies claimed 0.9 tons. That's an 11 times discrepancy between actual acquisition and official disclosure. November wasn't an anomaly. In September, China's central bank acquired 15 tons of physical gold. The official report stated a fraction of that amount, a 10 times gap between reality and disclosure. This pattern repeated across multiple months. China has been systematically accumulating gold while publishing minimal official numbers to international monitoring agencies. The real reserves are substantially larger than any public estimate. And according to Xi's document, they're approaching the threshold needed to execute the next phase. The article's reference to gold defining currency value wasn't philosophical. It was operational. In the emerging framework China is building, whoever controls gold pricing controls currency valuation. Whoever has the largest reserves has the final say in international monetary disputes. The document stated this explicitly. Precious metal pricing is shifting eastward. Not might shift. Is shifting. Whoever possesses and processes the most silver gains tactical advantage. Whoever holds the most gold gains strategic dominance. And China has been positioning for both, while Western markets focused on quarterly earnings reports and Federal Reserve meeting minutes. This explains the $4 trillion recovery in 30 hours. While retail investors sold paper contracts in panic, sovereign entities were accumulating physical metal. While technical analysts predicted further crashes, China was executing a documented strategy published in plain sight. The volatility wasn't random. The paper price collapse created the perfect environment for large-scale physical accumulation at suppressed prices. And now, according to official Chinese government policy, the preparation phase is nearly complete. The September 3rd military parade in the financial sector approaches. The global gold final battle is about to break out, and most investors have no idea this document even exists. When China officially reveals reserves that are 10 times or 20 times higher than currently reported figures, when the pricing mechanism shifts from London and New York to Shanghai, when gold reprices based on physical possession rather than paper derivative contracts, the entire global currency system will adjust in a matter of hours, not years. This isn't a prediction. It's documented Chinese government policy. Published. Official. Executed. The question is no longer whether this shift will occur. The question is whether you'll recognize it before it's already happened. There's a bond market most Americans have never heard of that's about to reshape everything they thought they understood about global finance. Japan's 30-year government bonds just hit a yield level that hasn't existed since these instruments were first created. To understand why this matters, you need to understand what's been holding the entire Western financial system together for the past 3 decades, and why that structure is now coming apart. Japan carries a debt burden that makes every other developed nation look fiscally responsible by comparison. Their debt-to-GDP ratio stands at 250%. For perspective, the United States, already drowning in obligations, sits at 120%. Japan's government owes more than twice its entire economic output. Yet for 30 years, this didn't matter, because Japan created the most elegant financial engineering scheme in modern history. It's called the carry trade. Here's how it worked. Japanese institutions and investors would borrow money domestically at essentially 0% interest. They'd then send that capital to the United States and purchase treasury bonds paying 4% to 5% annual yields. The difference, that 4% to 5% spread, represented pure profit with virtually no risk. Multiply that across trillions of dollars in 3 decades, and you understand how Japan became the largest foreign holder of U.S. debt, $1.22 trillion worth. That's more than China, more than the United Kingdom, more than any other nation on earth. Japanese capital has been funding American deficit spending for an entire generation. But something changed in the past 6 months that broke this 30-year arrangement. Japanese bond yields started rising, not gradually, aggressively. As of this week, Japanese 30-year bonds pay 3.7% annual yield. American 10-year treasuries pay roughly 4.0%. The spread that once offered 4% to 5% profit now offers 0.3%, 0.3%, and that 0.3% difference doesn't even account for currency risk. The Japanese yen has been volatile, fluctuating against the dollar in ranges that can easily wipe out a 0.3% interest advantage. So here's the question. Every Japanese institutional investor is now asking, why would we send capital to America, accept currency risk, and deal with foreign exchange complications for an extra 0.3%? When we can simply buy our own government bonds at 3.7% with zero currency exposure? The answer is simple. They wouldn't, they aren't. And that's the problem. Hundreds of billions of dollars, potentially the entire $1.22 trillion over time, is now being pulled out of U.S. Treasury markets. When bond supply increases and demand simultaneously decreases, prices fall and yields spike. When Treasury yields spike, borrowing costs across the entire economy rise, corporate debt becomes more expensive, mortgage rates climb higher, consumer credit tightens, and asset prices, stocks, real estate, everything priced relative to the risk-free rate, must adjust downward. The S&P 500 already dropped 2% in recent sessions. Over $1 trillion in market capitalization vanished. But that's just the beginning of the repricing if Japanese capital continues flowing home. The situation became serious enough that the U.S. Treasury Secretary personally contacted Japanese officials, not through normal diplomatic channels. Direct communication. The explicit purpose was to request intervention to calm markets. Think about what that means. The United States Treasury Secretary is now calling foreign governments, asking them to stabilize American financial markets. That's not a position of strength. That's desperation disguised as diplomacy. And the Federal Reserve took an even more unprecedented step. They began actively supporting the Japanese yen. The U.S. Central Bank is now propping up a foreign currency to prevent capital flight from destabilizing American bond markets. This has never happened at this scale in modern financial history. Meanwhile, the U.S. dollar experienced its fastest weekly decline in at least 2 years. Not a gradual weakening, a dump. The 10-year Treasury yield is approaching the highest level seen since August, when markets experienced significant turbulence. Every indicator points to stress. Forced liquidation, stress. Margin call stress, systemic deleveraging stress. And this is why gold and silver initially got crushed despite strong physical fundamentals. When margin calls spread across the financial system, traders don't sell what they want to sell. They sell what they can sell. Liquid assets get dumped first. Precious metals, despite being in physical shortage, got hit because they could be sold quickly on paper markets to raise cash for margin requirements elsewhere. Gold dropped to $4,400. Silver crashed below 73 hours. Not because fundamentals deteriorated, but because traders needed liquidity immediately. But here's what separates informed capital from panicked retail. Sophisticated investors understood the forced liquidation for what it was: a temporary dislocation, a gift, an opportunity to accumulate physical assets at artificially suppressed paper prices, and that's exactly what happened during those 30 hours of reversal. The moment forced selling exhausted itself, the underlying bid returned with force. $4 trillion recovered in 30 hours. Because central banks never stopped buying, China never stopped accumulating, physical demand never disappeared. Only paper got flushed. Now consider the Trump administration's response to this environment. They announced a $12 billion critical minerals stockpile program. Not a proposal, an operational program. Funded through a $10 billion loan from the U.S. Export-Import Bank plus $167 billion in private capital. The explicit purpose is to secure physical commodities, gold, silver, rare earth elements, before currency devaluation accelerates. Read that again. The U.S. government is officially launching a program to stockpile physical assets as a hedge against their own currency losing value. They're not even hiding it anymore. The official policy is to convert paper dollars into physical strategic resources before those dollars buy less. When the government itself is telling you to own real assets instead of paper currency. When the Treasury Secretary is calling foreign nations begging for market stability. When the Federal Reserve is propping up foreign currencies to prevent capital flight. These aren't signs of strength. These are signs that something fundamental is breaking. Japan's carry trade made the last 30 years possible. It funded American deficits without consequence. It kept Treasury yields artificially low. It allowed the Federal Reserve to print without immediate inflation. That structure is now unwinding. And the $4 trillion precious metals recovery in 30 hours was the market's first response to recognizing what comes next. There are two silver markets operating simultaneously right now. One exists on computer screens in New York and London. The other exists in vaults, refineries, and dealer inventories across Asia. And the gap between these two realities is about to force a reckoning that most investors aren't prepared for. Western spot silver trades at $88 per ounce. That's the number financial media reports. That's the price retail investors see on their brokerage platforms. That's the figure analysts reference when discussing precious metals. But in Shanghai, physical silver spot trades at 114 per ounce. Shanghai futures contracts, which represent near-term physical delivery obligations, trade at $102 after bouncing from $95. That's a $16 premium over Western paper pricing. A 20% gap between what paper contracts claim silver is worth and what physical metal actually costs to obtain. Even after a 40% crash and a 20% recovery, the premium hasn't disappeared. It compressed slightly, but it remains stubbornly elevated. This tells you something critical about supply and demand reality versus paper market theater. Physical metal trades above paper pricing because physical metal is genuinely scarce. Paper contracts trade lower because paper can be created infinitely through leverage and fractional reserve practices. One market is constrained by geology and refining capacity. The other is constrained only by margin requirements and regulatory limits. And right now, the physical market is screaming a message that paper markets are trying to suppress. The evidence is everywhere once you know where to look. Bullion dealers across major markets are running out of inventory, not experiencing temporary delays, actually running out. Singapore saw queues form outside banks even as paper prices crashed. These weren't panicked sellers. These were informed buyers who understood the disconnect and acted accordingly. Vault data confirms what's happening beneath the surface. A 2.8% drain in a single 24-hour period. Not over a week of trading, not across a monthly cycle. 2.8% of registered silver inventory vanished in one day. If that rate continues or accelerates, the mathematics become impossible for short sellers, because unlike paper contracts that can be rolled forward indefinitely, physical delivery obligations must be settled with actual metal, and actual metal is disappearing from the warehouses where it's supposed to be waiting. Meanwhile, stock market concentration has reached levels never before recorded in financial history. The U.S. equity market has never been this top-heavy. A handful of mega-cap technology stocks now represent a percentage of total market value that exceeds every previous bubble peak. When structures become this imbalanced, they don't correct gradually, they break suddenly, and when that break occurs, capital doesn't simply vanish, it flows somewhere else. History shows it flows to real assets. Gold, silver, physical commodities that can't be printed, diluted, or created through accounting entries. We're already seeing the early signals of this rotation. Silver and gold are outperforming broader markets despite extreme volatility. Strategic commodities are showing strength while equities wobble. These are the warning signs that informed capital reads as a flashing red alert. Something is seriously wrong beneath the surface. Now we approach March. For those unfamiliar with commodity markets, March represents a major delivery month for COMEX silver futures. Contracts written months ago will come due. Holders of those contracts will have a choice: roll them forward into later months, or demand physical delivery. COMEX registered stocks, the metal actually available for delivery, have been depleting for months. China has been secretly accumulating at 10 times reported rates. Singapore buyers are queuing, dealers are selling out, vaults are draining at 2.8% daily rates. What happens when March delivery demands hit a system that's already stretched thin? Two scenarios emerge. Scenario 1, renewed forced liquidation. Systemic stress from Japan's carry trade unwind overwhelms physical fundamentals. Treasury yield spikes trigger another wave of margin calls. Metals get sold again to raise cash. Prices temporarily collapse further as leverage unwinds. This is the bear case. It's real, it's measurable. The risks are not theoretical. Scenario 2, physical squeeze. Shortage dynamics override paper manipulation. China announces actual reserve figures that are 10 or 20 times higher than officially reported. Every central bank globally rushes to accumulate before the repricing completes. COMEX defaults on delivery or forces cash settlement. The pricing mechanism shifts from London and New York to Shanghai. Physical possession becomes the only metric that matters. This is the bull case. And it's supported by substantial evidence. $4 trillion recovered in 30 hours while retail sold. 8% daily vault drainage. China buying 10 times reported amounts. Xi Jinping's official gold strategy document. Singapore queuing behavior during price crashes. SLV hitting $41 billion in trading volume, exceeding every stock on Earth. Bullion dealers down to final inventory units. U.S. government launching $12 billion mineral stockpile. These aren't random data points. These are strategic positioning moves by entities that understand what's coming. The unresolved tension sits between these two scenarios. Japan's debt crisis is real and quantifiable. Treasury yield stress is measurable and ongoing. These forces create genuine downside risk. But physical fundamentals are also real and measurable. Vault depletion doesn't reverse overnight. Chinese accumulation isn't stopping. Government stockpile programs indicate official concern. The question isn't which scenario is possible. Both are possible. The question is which force proves stronger: paper market manipulation or physical market reality. And that answer will likely emerge in March when delivery obligations meet available inventory. Here's what serious decision makers need to understand. There are two games being played simultaneously. The paper game involves leverage, derivatives, futures contracts, and margin requirements. It's fast, liquid, and entirely dependent on confidence and counterparty obligations. The physical game involves actual metal, actual delivery, actual possession. It's slower, less liquid, but ultimately independent of paper market confidence. You must know which game you're playing. If you're trading paper contracts for short-term profit, you're playing the volatility game. Japan's crisis matters enormously to you. Treasury yields matter. Margin requirements matter. You must be prepared for violent moves in either direction. But if you're accumulating physical metal for long-term wealth preservation, you're playing a different game entirely. Paper price volatility becomes opportunity, not threat. Forced liquidation creates buying windows. Physical scarcity matters more than screen prices. The mistake most investors make is confusing these two games. They apply short-term paper market logic to long-term physical positioning. Or they ignore paper market risks because they believe in physical fundamentals. Both approaches miss the reality. The paper market creates the volatility. The physical market creates the floor. Sophisticated capital understands this distinction and positions accordingly. They accumulate physical during paper crashes. They sell paper rallies to fund physical purchases. They don't confuse temporary price with permanent value. So as March approaches and delivery pressures build, as Japan's carry trade continues unwinding, as China's accumulation proceeds in secret, as vaults drain at accelerating rates, as government stockpile programs expand, the separation between paper theater and physical reality will likely become impossible to ignore. One market will prove to be the real price. The other will prove to be the temporary fiction. History suggests physical reality always wins eventually. The only question is timing and your position when the gap closes. Do your own due diligence. Understand both scenarios. Recognize the risks in Japan's debt crisis and treasury yield stress, but also recognize what $4 trillion recovered in 30 hours actually means. Recognize what 2.8% daily vault drainage implies. Recognize what official Chinese government policy documents reveal. Use logic, not hype. Use data, not hope. And most importantly, know which game you're actually playing, because March is coming, and one way or another, these two markets will converge.